Hello, I'm Peter Atkinson from Atkinson's. Welcome to this webinar which is looking at auto-enrolment, the government's latest idea to give us all a heart attack. Auto-enrolment is about pension reform, but don't go to sleep because it's about pensions. This change is going to affect all companies in a very significant way. The webinar is designed to give an overview of the reforms, information on how it will work, and details of how we can help take away the pain by working with you to deliver a solution. Under new rules phased in from October 2012, employers will have to automatically enrol their staff in a workplace pension and pay a minimum contribution into the scheme. It's been described as the most radical change to workplace entitlements since the national minimum wage. It will affect every company, no matter how large or small. We're going to talk about the rules and how the plans that we're making can help you plan for this. But don't think that this can be ignored. There's a really big sting in the tail. Failure to apply the auto-enrolment rules can mean fines, depending on the size of the company, of up to £10,000 a day. Now, for the bulk of our clients with up to 50 employees, the fine's been set at £500 a day. So we think it's worth getting this right. So what is it? Well, the scheme's already up and running. You've seen the adverts on the television, we're in, and the biggest companies are already doing this. Every employer must have a suitable qualified pension scheme and must automatically enrol eligible employees into the scheme and pay a minimum contribution. The rules are being phased in by size of company, so the biggest first, the smallest last, between 2012 and 2018. There are cost implications as well, as we'll see as we go through, and there's a host of additional work that has to be done as well. In a recent survey, most firms weren't aware of the detail, and of those that are aware, most thought it very complex or complex. I think that's because it seems quite a long way away, but it isn't. We need to make plans now about how we're going to comply. And it affects every business. If you have a pay-as-you-earn scheme, that's you. You can see why the government chose to get the big employers to go first. Small start, but building into a tsunami as the bulk of businesses come on stream. You can see we've got 6,500 businesses with 250 plus employees. They're already doing it. They're already in. We've got nearly 30,000 businesses with between 50 and 249 employees, and they start doing it between April 2014 and April 2015. And then we have the massive 1.2 million businesses with between 1 and 49 employees. They stage between June 15 and March 2017. So, we see this tidal wave approaching of all businesses trying to put things in hand at the same time. So there's going to be a pinch point when everybody's trying to do it all at once. And if we look at our clients, we'll see we've got a similar position, except that we've got two peaks really, one in 2016, one in 2017, but we start to be affected in 2015. So that means we need to be ready, and we want to help our clients to be ready too. So we've developed a plan, and of course we put additional resources in place in good time to handle the rush. So there's quite a bit of jargon in the rules, and some new definitions about who's eligible to join in. As employers, you need to enrol your workers into a suitable scheme, and this means those who want to opt in, those joining, and those who've got a contractually ability to enrol. Employers need to manage those who want to opt out. We need to provide information, make contributions, and keep records. And it's quite broad. These record-keeping onerous duties have to last for about 6 years, so there's quite a lot to keep track of. So it sounds easy, really. Assess the workforce, identify qualifying earnings, the earnings that you base the contributions on. Identify the pay reference period, because not all workers work usual hours or regular weeks. Continually assess the workforce, because things change, earnings, ages, etc. And provide pension scheme advice. So let's start to take a look at these. First of all, we need to see when you as a business will be affected. Now you can look this up using your pay-as-you-earn scheme reference to that website there, the pensionregulator.gov.uk. We've done it for you, and of course you'll see your vesting date in your webinar invite. But if you've any doubt, please give us a ring and we can explain exactly what your date is. We then need to assess the workforce, and this assessment has to be done at each pay reference period because things change. So what is assessed? Well, the starting date, when the employee started work, their 22nd birthday date, their 16th birthday date, and these become important later on, when they receive the opt-in or joining notice, their state retirement date. Now that used to be easy, but of course the government have changed the rules there too. So we've got access to a calculator to calculate retirement dates for your employees. But here again, it's another twist that needs to be taken into account. So what's a worker? It's easy to think, well, it's just everybody, but it isn't. The workers in our employment fall into three categories. We have eligible job holders, and that's going to end up being most people really. We have non-eligible job holders, and we've got entitled workers. So the non-eligible job holder, they aren't automatically eligible, but may have a right to opt in to your scheme. And if they do opt in, then you as an employer are required to make a contribution to their pension. So it's quite important that we identify these non-eligible people. Entitled workers have a right to join the scheme, but you as an employer are not required to make a pension contribution. So again, it's important that we identify these entitled workers. So you can see it's vital that we do this analysis of the workforce really well and properly. So here we have more details of which people fall into which category. So firstly, think of the difference between entitled and employees and job holders. Both are aged between 16 and 74. Both will be working in the UK under contract. But entitled workers will not have qualifying earnings, whereas job holders will have qualifying earnings. We'll talk about what qualifying earnings means in a little while. So having seen that difference, we can now explore the difference in job holders between eligible job holders and non-eligible job holders. Well, the main difference between eligible and non-eligible job holders is the qualifying earnings. Eligible workers earn above the trigger point, and non-eligible people earn below the trigger point. Now that trigger point is currently set at the personal tax allowance, which is £9,440. However, bit of a sting again, non-eligible job holders can include those between 16 and 22 and those over the pension age who earn more than the trigger amount. So there's a few things to just remember there. So if you're still following me, this chart tries to make that and put it into a sensible summary really. We've got the earnings on the left-hand side and the ages on the right-hand side, and you can see that those earning under the lower threshold, regardless of age really, become entitled workers. Those earning between the lower threshold and the earnings trigger for auto-enrolment are non-eligible job holders, and those earning more than the trigger point for auto-enrolment can fall into any of those three categories depending on their age. So non-eligible job holders or eligible job holders. Now here we have a flowchart or a decision tree which will help you decide if a worker is to be included in auto-enrolment. So let me talk you through the chart. So there's a quick question at the top. Does the individual work under a contract of employment and work under a contract to perform work or services personally, and they're not working as part of their own business? So if the answer is no, they're not doing that, then follow the line down, the individual is not a worker for auto-enrolment and can be ignored. If they are, however, we need to ask the next question. Does the individual work or ordinarily work in the UK? If they don't, we follow the track down, they're not a worker. If they do, next question. Does the individual earn more than £5,668? If the answer is no, we ask the question. Is the individual aged between 16 and 74? If they are, they become an entitled worker. If they're not, they fall outside of scope. Back to the questions. If the answer is yes to that question, does the individual earn more than £9,440 in qualifying earnings? If they don't, we ask the question, is the age of the individual between 16 and 74? If they're not, they don't apply. If they are, they become a non-eligible job holder. Back to the questions. Is the individual then older than 22? If they aren't, we ask the question, is the individual older than 16? If they are, they become a non-eligible job holder. If they're not, they fall outside of scope. Next question. Is the individual then older than the state pension age? If they aren't, the individual is an eligible job holder. If they are over pension age, are they older than 74? If they are over 74, they're outside of scope. If they're under 74, then they are a non-eligible job holder. So complicated, but hopefully by using this map we can see exactly where people fall in our analysis. So having decided who fits where, we need to look at what makes up qualifying earnings. And that's important as it helps decide who is eligible, and of course contributions are made on these qualifying earnings too. Some workers receive unusual sorts of pay. It may be infrequent, it might cover non-standard periods, etc. Suffice to say, we can help you decide on those qualifying earnings as we move ahead in the detail together. We need to keep the lower threshold and trigger points in mind, because the lower threshold, this applies to entitled workers. Between the lower threshold and the trigger point, that applies to non-eligible workers, and over the trigger point, that can apply to all three types of workers we saw in that chart. And in terms of contributions, contributions to the scheme are paid on the earnings between the lower threshold of 5,668 and the upper threshold of £41,450. So you can see how important these definitions become, and perhaps how complicated it's going to be to get that across to our employees. So we need to think about what types of pay come into the net as qualifying earnings, and these items are included. It's salaries and wages, commissions and bonuses, overtime, statutory sick pay, statutory maternity pay or additional SSP, and statutory adoption pay. So the standard sort of things that you might expect to be included in those sort of earnings. So in terms of contributions, well, how much is paid in contributions? This again depends on the trigger point, and the trigger point is the staging date, which is shown on the left-hand side. So if we can see it's September 17 between October and September 18, and from October 18, the employer contributions go from 1% to 3%. The employee contribution, the worker contributions, from 1% to 5%, and that adds up to the total contribution. These are phased in, as you can see, depending on those trigger dates. Now that was for new schemes which were introduced as part of this auto-enrolment process. This chart shows the effect on existing pension schemes. And if you have an existing pension scheme, you simply need to make sure that it hits all the buttons, it ticks all the boxes, and that it can apply auto-enrolment as it goes forward. And if you have an existing pension scheme, it will fall between Tier 1, Tier 2, Tier 3. And the three tiers are really designed to cover the types of scheme that already exist: defined benefit, defined contribution, personal pension schemes, etc. You can see that the contributions differ by staging date as well, and it increases as we go through the time frame. The important thing here is that the employer needs to be satisfied that the scheme they use meets the qualifying criteria. And professional help is a real must here. As an IFA, a regulated professional must provide the advice. That sounds okay, of course, to any sensible chap, except remember the number of companies involved. 1.2 million companies between June 15 and March 2017. And if they all need an IFA, well, there aren't enough IFAs to go around. But don't worry, we've got a solution to that too, but more about that later. So we've analysed the workforce, identified qualifying earnings, identified the pay reference period, and offered pension advice. And we're all prepared to continually assess the workforce. All well and good. But workers can opt in and opt out depending on where they fall in that analysis of staff. Job holders or entitled workers can opt into the scheme. You have to tell them that they can opt in, and when they ask, we need to assess them and retain all the mandatory information. Job holders who are put into the scheme under auto-enrolment have a right to opt out. There's an opt-out period, a bit like a cooling off period, and if the opt-out happens within a certain time frame, then a refund of contributions might have to be made too. You can't, however, then forget about them. They have to be re-enrolled every 3 years from the original date, and then all this process starts again. Now bear in mind that records need to be kept of each of these stages, as we move through the process. So a quick recap on the legal requirements. Every company with workers needs to enrol workers into a qualifying scheme, arrange for opting in, joining and enrolment, needs to manage any opt-outs, provide information, make contributions and keep records, actually keep them for 6 years. So keeping records. Some companies might be tempted to let all this start going and then we'll catch up later. Well, it's very difficult, albeit impossible, to create the flows of correspondence between the company and the workers after the event. And of course, information needs to be given to the pension regulator and to employees, and of course the penalties are huge. We've talked about them. £500 a day for companies between 5 and 49 employees. And that leaps up to £10,000 a day for the very biggest companies. And there's already been lots of these fines issued, so the regulator means it. So on the right is a list of the sort of things that we need to be kept, and the sort of sensible things you'd expect, like name, gender, NI number, etc. So the staging date for you might seem a long way off, and 2015 does seem a long way. But we need to find out your staging date, make a plan, get ready to educate and inform the workforce, but most of all, let us help. The pension regulator has suggested an outlined plan that suggests that planning needs to start 18 months before the staging date. Well, our earliest staging date as a firm with a client is 1st of January 2016, but 18 months prior to that is July 2014, that's next year. So we're making our plans. We've found some terrific middleware with AVN. This is some computer software that sits between us, our payroll system and the pension scheme. More on that later. We've got a terrific set of payroll software that we can set up and handle all your payroll needs as well. And we've got more software available coming through at the IFA arm of the firm, AVN Wealth Managers, which can provide independent advice for each of our clients in terms of which pension scheme to opt for. So we're expanding our payroll department so that we're ready for the influx of additional work. We're here to help you develop your individual plans and to put them into place so that everything's in order and we can avoid the fines. Our software will be well placed to handle the payroll, auto-enrolment and the pension scheme information transfer and transaction processing. We've also signed up to the AVN Core solution. It's nearly ready for us to demonstrate, but we wanted to bring you the information about auto-enrolment now as we move forward into the planning stage. We'll be hosting another webinar to show you how this will work in practice as we move ahead. But the core system is an online system which sits between the payroll and the pension scheme. It can handle everything in the auto-enrolment process, provides full records and audit trails, and it's definitely compliant with the pension regulator rules. So in conclusion, we're ready for the storm that's coming. We've got expert systems and expert staff ready to help. So let's get together and talk about your detailed plan. Send me an email or give me a call or click on the button at the end of this webinar. Thank you for your time. I hope we've informed rather than frightened you, and don't forget we're here to help. And finally, who do you know who might need help to make all this happen? Send us their contact details so we can help them too. Thanks for listening. Goodbye.